Each team has 20 minutes to present its case to the judges. I will show a board for the 10, 5, last 2 minutes, and 30 seconds of the presentation. During the last 10 seconds of the speech, I will indicate by means of my 2 hands the remaining seconds as such. A team not having ended its presentation after 20 minutes will be stopped to move on to the Q&A. A period of question of maximum 5 minutes is assigned to the jury at the end of the presentation. I would like to remind that each judge that it's mandatory to ask at least 1 question during this period. Please note that you cannot reveal the name or the source of your university, as you will be disqualified. I would like to ask the public to turn off the ringing of their cell phone, and I will now invite the judges to introduce themselves.
Hi, my name is Alexandra Tanguy. I work as a financial analyst at OF2019 in the portfolio managers team.
Hi, my name is Laurence Patry. I'm also a financial analyst in the portfolio management team at the IE Financial Group.
Hello, my name is Alain Poulain. I'm a financial analyst, North American Equities at the IE Financial Group.
Hi, Jean-François Girard. I'm CFO at Barlow Baker.
À tous les jours, on prend une multitude de décisions. Ça peut être parfois des décisions qui ont un très grand impact sur notre vie, ou ça peut être vraiment minime. Par exemple, aujourd'hui, j'ai choisi quel vote j'allais porter. J'ai aussi choisi que j'allais présenter le code finance aujourd'hui. Bref, ce que je veux dire, c'est qu'en général, toutes les décisions qu'on fait make up for who we are as a person. Today, André, René, you are faced with decisions to make, choices to take, and they define you as an investor, well, a bet investor. And today we are ex-financial. My name is Anna. Here's my teammate Michael and Zach. We will be continuing the presentation in English. However, we're more than happy to answer your questions in French. So let's take a dive into André, René, dans le marché. So overall, here's all the questions that you asked us to answer. We have the answers for all of them, and we'll be going through them during the entire presentation. So here are our answers, and overall, we'll be coming down with a lot more specific details in the upcoming slides. So basically, you need to understand, who are you, both of you guys? Clearly, the story is that you had a bet in place. Who will have the best portfolios? Who will have the highest returns? André, you had financial knowledge, so you clearly knew a bit more about the markets and how they work. René, you wanted to show that anyone can do this, and that markets are pretty much just luck. I mean, both of you guys were right and wrong, in the sense that markets, yes, they're a bit of luck, but they're also educated guesses. So how do people in general make money off of the stock markets? So overall, they're expecting capital gain in the stock prices going up or down, for example. And dividends payout, so earnings dividends. So people, that's how they make money. So you need to understand the first step of investments before choosing which stocks you're going to invest in. So there's many ways to make money out of this, and there's very strategic ways of doing so. One of them is building a portfolio, definitely. So what you guys decided to do. So what is the goal of a portfolio is basically to diversify your assets and not put all your eggs in one specific basket. So you're going to choose different type of eggs, different type of industry, different types of return, different type of risk. So what this portfolio allows you basically is to have higher returns while minimizing your risk. So the key takeaway here is that you need to choose the right stocks that fit your needs and your strategy. For example, if you're a current investor and you're investing your actual own money, you will change your strategic fit to accommodate your future needs. So for example, if you really needed that liquidity on hand, you wouldn't be as risky in your choices of stocks. And the next idea that we need to keep in mind is that you cannot choose whichever stock. You can't just decide, I will take the 6 best, and they will be the 6 best next year. The market changes, economic features change, the entire segments will change. So you cannot base yourself on historical data to forecast the future. You can use them to build an educated guess, but you need to update yourself and look at what is actually happening in the entire industry before you make that right decision. So overall, let's understand the 3 types of portfolio you decided to make today. So one that minimizes variance. So it's more of a highly diversified portfolio that will decrease the standard deviation as much as you can. So it's in that segment, it's the highest return you can possibly get for the lowest variance ever. So this one is kind of limited. It is an efficient portfolio, but it's not the most efficient or the most high rewarding because you're minimizing yourself on that minimum variance. When you look at the maximum Sharpe ratio, it's the highest Sharpe ratio, the highest return for the lowest variance. So in a sense, somewhat similar, but it's not the same. It's not the smallest. It's that variance specifically for that specific return. As for equally weighted portfolios, it's achieving, yes, diversification, but with no further purpose in your strategic fit. So you're just putting all equal stocks in the same diverse weight. But you're not taking into consideration that maybe a specific stock is not going to perform as well, so you should probably decrease its weight. Overall, you're just putting all your eggs on the same level, whereas some of them are a lot more valuable than others. So you're not taking that into account. So these are things that we need to consider when you make that portfolio and to choose which one's the right one. So let's just dive in a bit more. So we said minimizing variance. So at every return, you have the lowest possible variance. And you clearly see that it's the second dot up there. That is your minimum variance. So key takeaway, it's the highest return for the least amount of risk possible. Understanding the maximizing Sharpe ratio. What is the advantage of that Sharpe ratio? Is that yes, it helps you compare the change of overall risk. But it also helps you define if this investment was actually smart. So if you look at this Sharpe ratio, you will be able to figure out whether or not this investment was right for you or not. Equally weighted, definitely like I said, there's pros and cons. Pros, you did a selection, you chose your stocks. However, you did diversification as well, so you not stay in the same type of industry, but you chose a bit different. And the cons is, however, you did not adequately allocate. You assume that all those stocks should have the same returns, same risks, for you to specifically decide that this entire portfolio should have the same amount of returns. So there's no strategy behind an equally weighted portfolio, which is we don't believe is the best strategy for you. So overall, when we look back at the entire presentation, we valued all of the portfolios, but in our opinion, the equally weighted portfolio is not the best approach. So overall, let's understand how you made your decisions according to your different portfolios. For the max Sharpe ratio, you decide to choose the 6 best, 6 worst stocks performance in 2016 to 2017. Some might say it might be a smart way of doing it because let's say the 6 best kind of downperform, and maybe the 6 worst are going to actually outperform. Yes, but it's first level. You haven't considered any other factors in the industry. You haven't actually allocated your time to looking at specific industries and choosing which ones are the right fit for your needs. We do know that it's a bet, but if you wanted to play like a real investor, you would have to consider that as well. As for minimum variance, you chose the 12 best securities. Could be definitely an interesting thing, but the one thing that we still have to remember is that it's not because they were the 12 best last year that they will be the 12 best the next year. You're still taking on another risk by just choosing this assumption. As for equally weighted portfolio, it was as well the 12 best. And the weights were allocated based on a program that would give you the highest returns possible. As for Renee, basically did the similar thing. However, he chose the 6 best and 6 worst in the first one, and the 12 worst for the last one. Could be a strategic fit. Maybe he saw something in the market, but clearly it was out of luck. Now we need to understand what type of returns did all of those portfolio give us. I'll now pass it on to Michael for asset allocation.
Perfect, thank you, Anna. So maybe before we get into the specific asset allocation and the performance of each one of those, we can have a look at a sector overview for each of the sectors that we'll be looking at today, and maybe a bit of commentary for each one. So our outlook for 2019 is very positive for financials, consumer staples, and healthcare. The reason for that is mainly due to the reduced growth that we expect to have in 2019 versus 2018, with tariffs taking place right now in the market, and the market's starting to feel the effects that those tariffs are having on the worldwide economy. We have interest rates that are also rising, which can be a nice tailwind for financials. And consumer staples and healthcare have been chosen by us because of their defensive nature. So they're more defensive industries, which is more susceptible to outperform in times of potential distress. So we think there is a possibility for some more volatility to continue into 2019, and these are good sectors to invest in if you'd like to position yourself for such a scenario. Okay, so having a look at our benchmark. So the TSX 60 is the benchmark we'll be using today. As you can see, the vast majority of this index is composed of 3 sectors. That's financials, energy, and materials. So that kind of describes the Canadian economy, very heavy in financial services, materials, oil and gas out west. So this makes up a large proportion of the entire Canadian market. So having a look at the maximum Sharpe ratio portfolios for both André and René, we can see that both portfolios have very varying levels of asset allocation. So if we look at André's on the left to begin, we can see that there's large swings of overweight and underweight allocations. So for example, in materials, we see that Goldcorp has an underweight allocation. It's a short of 45% of the overall portfolio size, which is very huge. And conversely, on the long side, we see that Waste Connections has a 127% overweight position. So that's absolutely huge. And to finance that, they went short other stocks, specifically in the energy and the material space. So such a portfolio can be very good or can be very bad. So depending on the performance of these sectors, you'll either outperform or underperform severely, and it can very much impact your performance for the year. So having such a concentration is a very risky portfolio, and we think that it might be good for portfolio managers that have a specific view on the industry or the sector, and they have an outlook that they'd like to see materialize in the future. But if the stocks are picked at random, it might not be the best option. For example, Waste Connections has such a high weight because it's a low beta stock and it has a very high return. So that's why I guess the model for the Sharpe ratio selection chose a stock like this. On the other hand, Goldcorp has a low beta and a very low return, which is why it has the largest underweight position. When we look at René, you can see it's a lot more balanced than André. So his portfolio is actually long Goldcorp, whereas André's is short, and we can see that the energy sector is kind of a mix of long and short, and the rest is pretty much long. So looking at the returns that you can get from both portfolios, André's expected return is slightly higher than that of René's, and the Sharpe ratio for André is actually less than the Sharpe ratio for René. And that's what we're looking for. We're looking for the portfolio with the higher Sharpe ratio, and in this case, René's portfolio would outperform his buddies on that basis of Sharpe ratio. So if you look at the beta of the portfolio, you'll see that the beta for André is also a little bit higher than that of René's. And when you think about it, they're taking the top 6 performers and the bottom 6 performers. Is this really the best way to go about selecting your stocks? What other factors are there? As Anna was mentioning, there's a lot to research when you look at a company. What are the earnings? What's the management? What happened in the past is not as important as what will happen in the future, especially when you buy the stocks today. So as a key takeaway, René has the highest Sharpe ratio, but he does have a lowest return. But in this case, we're looking for the maximum Sharpe ratio, so we'd be looking to choose René. Now on to minimum variance. So we had a look at André and René, and at first glance you can see that André's portfolio has overweight and underweight positions, and long and short, and René is only long. So he goes long all his positions. And which one would you want to pick if you were an independent party? You want the minimum variance portfolio. So having a look at the standard deviation, we see that René has a lower expected standard deviation at 1.2%, and André has 1.38% as an expected standard deviation. So that's the first kind of filter we can look at when looking at these two portfolios. The second thing we decided to look at was the composition of the holdings. So what sectors were they operating in? You can see that André's portfolio is much more concentrated and in materials and energy, more specifically. And then we have René, who is a lot more diversified. We can see that he has some holdings in consumer staples, consumer discretionary, healthcare, technology, materials, you name it. I mean, it's almost all the sectors that we talked about earlier. And we believe this is a much more well-rounded portfolio, and it's more important to have a well-rounded portfolio, especially when we talk about minimum variance, because we're looking at historical results, and these historical results are using the performance of the sectors for the past year. What if next year these sectors all have a similar type of performance? So André's portfolio, since it's very heavily invested in materials and energy, if these two sectors tank, they'll be highly exposed to that fluctuation in price. On the other side, René, he has a lower expected standard deviation, and if these two sectors decide to go down, they're still supported by other sectors which might be on the more defensive side. So for that reason, we think that René has a more suitable portfolio with regards to diversification and risk versus reward. Now lastly, onto the equally weighted portfolio. So the most important thing that we looked at here were three things. So we had the expected return, expected risk, and diversification of sectors. So since they're all equally weighted, we got to look at the sectors one by one and see which one had the most diversification. And once again, René had the most diversification. So for the same reason, if you go with André and the materials and energy sectors decide to go down, it will be dragged down with it. However, René is a lot more diversified and has a slightly higher expected return than André, along with the lower standard deviation expectation. So as such, if we look at the Sharpe ratio for René, it's also much higher than that for André. So we would also go with René on this one. So we say René got lucky on this one because he kind of got to choose his stocks at random. He doesn't know very much about the market, yet he outperforms his buddy André with a higher expected return and a lower level of risk. So that's very interesting to note, and we'll continue looking at the ratios. I'll pass it on to Zach.
So real quick, we're just going to take a look at the ratios you requested us to calculate for all the portfolios that they had selected. So first off, before jumping into it, I just want to note that for René, the equally weighted portfolio is not actually in terms of percentage because he was not as knowledgeable. He bought the same amount of shares for each stock, and so just keep that in mind. So for André, for the maximizing Sharpe ratio, the actual realized returns for mid-year 2018, because you asked us to look for halfway through the year and year-end, were actually 13%, which makes sense because we had a pretty bullish year actually for the first half, and we all remember the pretty disastrous ending it had, sadly, so we can see the impact of that. We will be able to see the impact of that on the next slide. So for the minimum variance, he still performed better, and finally for the equally weighted as well. On the other side, you can see that René did not perform as well for the first half of the year. Now, what we need to keep in mind is that what Michael outlined in his section was that René had a higher Sharpe ratio across all his portfolios. So he had more returns for the amount of risk he was taking, and his beta was typically lower, so he was taking less risk than René. Now, jumping to the next slide, we can see that where they maximize the Sharpe ratio, it still worked out well for André. But for the minimum variance, sorry there, I think I might have reversed a few columns, but in the end, what it means is that René performed better than André for the actual returns for each portfolio because he took less risk than André. So looking at the actual ratios, so the trainer ratio, what the trainer ratio does, it looks at the actual returns that you got per unit of beta for the year that has been realized. So for the maximization Sharpe ratio portfolio, the trainer ratio was 12.49. So that means that this portfolio actually got 12.49% of returns for each unit of beta that it had. For the minimizing variance, it did not perform as well at all, and so it had minus 11.35% units of return for each unit of beta. And for the equally portfolio, it also performed poorly, and so for each unit of beta, it had extremely poor performance. Now taking a look at the Jensen's alpha, what the Jensen's alpha is it takes a look at what return you achieved above and beyond what was forecasted with CAPM. So what you do is you take the realized returns for the year, and you subtract what amount you would expect according to CAPM, which is risk-free rate plus beta times your market risk premium. And so what we can see here is that for Jensen's alpha, André actually had better performance with the maximizing Sharpe ratio. Sorry, guys. Okay. Now, taking a look at René, his trainer ratio was minus 10.65%. So it's here again in terms of per unit of beta. And for Jensen's alpha, he actually performed a lot better than what is expected with minimizing portfolio variance. Now, if we compare this to the index ratios, so for the TSX 60, the trainer ratio was minus 15%, and the genesis alpha was 5%. So what we like to really say today is that you can't look just at historical returns to decide how you're going to allocate your portfolio. You need to look at what the macroeconomic trends are going to be for the following year. In the end, Rene took less risk on than Andre. And so we believe that that's why he performed better in the end due to the rough year that 2018 was overall. So if you were to make the same bet today, we suggest you use more strategies that would imply sector allocation or stock picking so that you can take advantage of overperformance in sectors that you know will perform better in the next year. In the end, chance can allow you to get great returns if you choose such a tactic, but it is better if you actually use a strategic approach, which will, over the long run, give you better performance. We thank you for your attention and open for the questions.
Okay, according to your market view, can you suggest me an option strategy that will benefit from it? I'm not ready to pay a lot, but I'm ready to sacrifice some upside return.
You mean by acquiring options on the market?
Yeah.
So if you were to want to take advantage of potential upside in the market with options, you would have to select the sectors that Mike had outlined as outperform for the next year. So these were consumer staples, financials, and if you could just move for the last one?
And healthcare, yeah.
Healthcare. So you could buy options on stocks that you believe will outperform even this sector in itself for 2019. And this would allow you to actually put in more leverage in your portfolio since stocks give you, not stocks, but options actually increase the leverage when you use them.
And for the sector that will underperform, do you have another strategy?
Yeah, you could be long on some puts for those.
I would like to know if the minimal variance portfolio in January is going to be still accurate a few months later in July, for example.
Okay, so the minimum variance portfolio that we created today, we want to know if that's going to be the same
Exactly.
6 months from now, let's say. So that's a very good question because the portfolio allocations are, we would recommend to rebalance every month because of the portfolio, the fluctuations. And since we expect the market to be quite volatile this year, we think that's especially important for 2019. Portfolio rebalancing is very important because let's say a stock either goes up or goes down very much. It's important to not have too much exposure or not enough exposure to a specific asset. So rebalancing on a monthly basis is what we'd recommend.
We could see that Andre was 45% short in Gold Corp. Do you see it as a problem, and what would you recommend as a strategy to implement to minimize the risk?
Well, he was long Gold Corp, which we know is considered, gold in general is considered a safe haven when there's high volatility in the market or there's war in the market. Now, what happened during the second half of the year is that the market tanked, and so gold appreciated. We would, this means that it was good for René, who was long Gold Corp, right? It's Andre, sorry.
I think Andre is short 45.
Yeah, okay, yeah, short 45,
Yeah.
exactly.
Yeah.
So he was short 45 on Gold Corp, and since there was high volatility, the market did bad, gold appreciated, so that was bad for him. So essentially, that goes back to what we were saying. You need to take into account your outlook for the following year when you acquire these stocks. So if he wasn't worried about the next year, well, he didn't have any reason to hedge this. If you are going to take into account, like right now, investors are kind of worried for 2019, and so we would not suggest shorting a gold corporation. We would actually recommend you long gold right now.
And do you see any problem being short? Any stocks on any sector? Do you see problem being that much short, or it's okay for you in your investment policy?
It's extremely risky. So if we look at Andre versus René specifically, being 45% short on one single stock is very risky because you have your entire portfolio and you take almost half of it and you go short a stock. So what if the stock appreciates, you get squeezed, and then you won't be able to cover your short? That's a major risk, and we'd probably recommend having some risk management practices put in place to cap our short positions at a certain percentage. So say we'd be able to speak with the investor and see 5%, 10%, or 2%. So that's how we mitigate that.
If we expect a market downturn, what do you suggest me according on the number of title of stock we need to have in the portfolio?
Increase, decrease, stay the same. The number of stocks. If there's a market downturn, would you suggest increasing the number of stocks, declining the number of stocks?
Yeah, if we expect a market downturn, actually, you can still achieve more benefits from diversification by increasing the amount of stocks from your portfolio significantly beyond 12. So 12 stocks is actually not enough at all to fully diversify your portfolio. So we would suggest you increase it. Yeah.
One more question.
I think that's it. Thank you very much, guys.